Volatile penny stocks come with significant risks but also the chance for outsized returns. If you have $100 you're comfortable losing, these 3 picks may be worth considering. Penny stocks carry substantial dangers. The SEC requires risk disclosure for traders. The disclosure makes it clear, you can lose your entire investment. Interest in penny stocks remains strong, as investors seek transformational gains. What makes penny stocks so risky, and which stocks might be appealing now? Let's break it down for potential investors looking at small capital risk. Penny stocks: young companies, minimal revenue, and major uncertainty. The appeal of penny stocks is simple. Small price increases mean potential big returns. Returns can be 2x, 5x, or even 10x with a minor price increase. However, the downside can be brutal if you invest more than you can afford to lose. Most penny stocks are new and untested, with limited revenue and no profits. Low liquidity can mean struggles to sell, even if you're sitting on a profit. Before investing, always do your own research and be cautious. If you have $100 to lose.
Sector: materials. Market value: $130 million. Gold resource. Goro is a gold producer with a stronger foundation than the average penny stock. It trades on the NYSE's small-cap platform rather than over-the-counter, giving it added visibility and credibility. Although Goro recently traded below $1 per share, the stock has climbed roughly to 150% year-to-date through mid-December. And unlike many early-stage penny stocks with little to no revenue, this mining company reports actual production numbers and continues to advance its mining operations. Still, Goro faces the same risks common to commodity-linked businesses. Gold prices have had a strong run in 2025, but any meaningful pullback could weaken the stock's momentum. The company also reported a quarterly loss in its November filing, even as several larger gold miners delivered solid profits. Even so, for investors intent on exploring penny stocks, Goro is more substantial than most. Its connection to gold, especially in the current macroeconomic climate, provides a level of legitimacy that companies relying solely on unproven concepts don't have. Notably, both analysts tracked by S&P Global Market Intelligence rate the stock as a strong buy. Sector: financials. Market value: $869.4 million. Strive Asset Management AST, a wholly owned subsidiary of Strive, oversees the parent company's assets. Like many asset management firms, this penny stock essentially represents a wager on the company's active investment strategy, and Strive has made it clear that its strategy is heavily focused on Bitcoin. That approach worked well in early 2025, when Bitcoin surged and AST shares skyrocketed from around $0.60 at the end of 2024 to more than $13 by May. But Bitcoin's subsequent downturn has hit the stock hard, sending it back under $1. The reason is simple. According to its latest filing, the company held 5,886 Bitcoin as of September 30. Purchased at an average cost of $116,053 each. With Bitcoin now trading closer to $90,000, those holdings are deeply underwater. If you're bullish on Bitcoin and prefer gaining exposure through a company like Strive rather than managing crypto directly, VAST could be a penny stock to keep an eye on in 2026. Sector: consumer discretionary. Market value: $38.3 million. Noodles & Co. NDLS is a fast casual restaurant brand founded in 1995, offering a wide selection of noodle-based dishes from mac and cheese to Italian and Asian-inspired options. The company owns about 360 locations, franchises nearly 100 more, and generates close to $500 million in annual revenue. Despite this scale, NDLS trades as a penny stock due to heavy debt and shrinking profitability. Recently, investors have been encouraged by easing labor and rent costs, helping the stock rise more than 40% year-to-date. However, the situation is complicated by activist investor group Galloway, which has taken a stake in the company and is pushing for major changes, including selling most company-owned locations and revamping the operating model rather than waiting for gradual improvements. Battles between activist investors and management carry inherent risks. At best, they create distractions. At worst, the resulting strategic shifts may harm shareholders. Still, NDLS is a functioning business with meaningful revenue. If you believe in the brand's long-term potential or think a restructuring could unlock value, this penny stock may deserve closer consideration.